We're taking a look at the currency market now with Nomvuyo Guma, Macroeconomic Strategist at Standard Bank. Thanks so much, Nomvuyo, for joining us this morning. We're taking a look at the rand this morning, steadying against the dollar, but very much being expected to weaken towards that 6-week low of 8.30 as we have these ongoing concerns about the Eurozone debt crisis persist. Take us through what you're anticipating for the trading day ahead.
Hi, Alishia. The sentiment in markets remains highly risk-off, and so we would anticipate another volatile trading day for the rand. As you mentioned, our short-term target is indeed close to 8.30. We've got a target of 8.29 in mind, and the rand came very close to that yesterday, so could in fact breach that level today should the mood get much worse. Should it make a sustained break above that, then the next level we'd be looking for is 8.40, but we'd need a significant deterioration in market mood for that to occur.
Of course, yesterday, what contributed to that deterioration in a market mood was the kind of results that were yielded out of the Spanish and French auctions, bond auctions that were held yesterday. Let's take us through Standard Bank's house view on what's playing out on that end and the kind of yields that these bonds are fetching.
Yes, well, we remain quite concerned about the situation in Europe. I don't think there's anything new in that statement. As you mentioned yesterday, Spanish bond yields hit a Euro era high, not seen since 1997, very close to the 7% mark, which is considered risky. That's the level at which other European countries have encountered great difficulties, Greece amongst them. And so the fact that they came within a hair's breadth, Spanish bonds came within a hair's breadth of that level, which is considered quite critical, really spooked markets. And of course we saw a sell-off in risky assets, and that was reflected in the rand as well. So going forward, of course, we are going to need some additional action out of the Eurozone. We'd be looking for decisiveness in policy making. In fact, Minister Gordon commented on that yesterday, that the situation in Europe, the fact that it's been dragged out for so long, the fact that there's still a lack of clarity over when we can expect a final resolution to this situation, risks actually dragging the entire world economy back into recession. So I don't think it would be untoward to say that the situation is gravely concerning, and there are adverse consequences for the entire world economy.
Certainly, that's what the markets have been calling for all along, you know, some decisive action to emanate out of the Eurozone territories. And it's the kind of developments we've seen on that end that have taken the spotlight away from the US. It's just a dire situation that we're facing on that end, Nomvuyo. I mean, we've got resurgent worries about debt management in the US that continue to plague. So let's put some of the focus back on the US economy and how you're reading that debt situation in a context where we're starting to see this encouraging economic data flow filter through.
Well, you're absolutely right that the spotlight has shifted off the US temporarily, but that doesn't mean that that economy still doesn't have problems. As far as the prospects are concerned, we still think there's a 50-50 chance about whether the US will slide into recession. Certainly the data coming out recently has been positive, but of course there are immense risks. As you mentioned, there's the debt crisis, there's the fact that there'll have to be fiscal cutbacks, and also the adverse risk posed by a potential meltdown in the Eurozone. The US economy certainly won't remain escape unscathed, and given the weakness of the economy currently, one could expect quite a huge impact on that economy. So we are still concerned about the US economy. The data is encouraging, but we still think that there is a risk that that economy could also slide into recession depending on what happens in Europe.
It's a pretty sparse data calendar today, but the one item on the agenda does come through from the US, and that with regards to US leading indicators. What are your expectations on that front?
Our expectations are pretty much in line with the market. The index rose by 0.2% month on month in September, so expecting the October figures out today. A much stronger print is expected, 0.6% month on month, and that of course could add to the optimism surrounding prospects for the US economy. But what we've seen happen lately on markets is that the turmoil in Europe has continued to overshadow the positive developments in the US. So unless we get a much stronger number than expected, we still think that the Euro crisis is going to dominate market activity. So we still think there's a lot of volatility ahead for the currency.